Good morning, everyone. Can everybody hear me okay? And can you see my screen? Just go ahead and put it in the chat. Okay, well, we're going to go ahead and get started. All that registered will receive a copy of this training. And I just wanted to thank you for taking the time to attend this morning. We are doing a micro training on assessing reverse mortgage suitability. So myself, I am Angela Wyckoff. I have been in the industry for over 20 years. My passion is reverse mortgage and helping seniors. So I just wanted to do that quick introduction, and I am representing Reverse Loan Solutions that is powered by AmeriFund. Hold on just a second, having a little technical difficulties here. Okay, so who are good candidates for a reverse mortgage? Homeowners that are age 62 or 62 plus or younger for proprietary products. There are products that go as young as age 55. Must generally have at least 50% equity in their home, must be financially able and willing to meet the loan obligations. And those loan obligations are taxes, insurance, HOA, flood, etc. So, just because they're getting a reverse mortgage that doesn't require a monthly mortgage payment doesn't mean that they won't need to make those additional obligations on their own. And the last one intends to remain in the home as a primary residence for the foreseeable future. You cannot use a reverse mortgage to extinguish your forward mortgage and then move out of the home for a long period of time or rent it out to others. So very clear on the fact that it must be a primary residence. So, what are their primary goals? There are two types of borrowers, of course. There's needs based and there's wants based. So, the needs based wants to mitigate the sequence of returns risk. So, they want to use the reverse mortgage so that they don't deplete or run out of money or outlive their money. They want to refinance their existing debt or eliminate their mandatory monthly payments. There are no monthly payments required on a reverse mortgage, but that doesn't mean that they can't make them or treat this like an interest only loan to stop the balance from growing at such a high rate. They can consolidate high interest debt to lower monthly expenses. They could use income tax free funds to improve cash flow and better manage their taxable income. The proceeds received from a reverse mortgage are borrowed money. They are not taxed as income. So it's very important to know that they're not going to get a 1099 for, all the money that they receive throughout the loan process. They can build a financial bridge to maximize Social Security benefits until age 70, or they can use the growing line of credit as reserve funds to cover healthcare. Now, in most cases, when someone is getting a line of credit in 10 years left untouched, that money can double. So it's super impactful to the longevity of their money. There are wants-based borrowers, so they can pay for large purchases and expenses like a new auto, RV, or they can travel. They can assist a grandchild heading off to college. They can fund renovation products, buy a new or better suited home, create a larger legacy for heirs, or, of course, philanthropy, donate to their favorite cause. When is a reverse mortgage possibly the right choice? So the first one is the client owns their home outright or has at least 50% equity in their current home. Next, the client plans to remain in the home for the next 3 to 5 years at a minimum or wants to purchase a new primary residence. If people don't plan to stay in their home for the long term, I don't always recommend a reverse mortgage because of the upfront costs, and we'll go over those on another slide. The client is carrying mortgage debt into retirement. So, of course, their main salary is gone. They still have their mortgage payment, and most times are just living off Social Security because, as we all know, pensions are pretty much a thing of the past. You have a client that's looking for more financial flexibility and or is living on a strained fixed income. Another client that is facing a sequence of return risk by liquidating investments to improve their cash flow, or a client who would like to increase legacy value for their heirs and foster portfolio longevity. So those clients that maybe come to you with, oh, I need a new car, I need to pull out some additional funds, I have to repair, the roof, I have to do some additional repairs, or just anybody who contacts you that tries to take additional funds outside of their regular mandatory disbursement. So this helps create a safety net. This is for clients that are looking to improve their cash flow while aging safely in place and to cover the cost of their monthly long-term care premium insurance. So this example is who wanted to do that. So I provided the client with 3 loan option scenarios to consider. So the borrowers were 64 years old. They had a $950,000 home that was free and clear. And I was able to convert that equity into monthly payments of $1905.41. Now, they used that. The wife had a long-term care policy that was $1,500, or I'm sorry, $1,000 a month. And they wanted to just put that money in their savings and pull from it as needed. And it's just not a smart way to go. So definitely looking at the options. You'll see the first column has the monthly payment, or they could just take that equity and put it in a line of credit. And again, as I mentioned, left untouched, that money has the potential to double in 10 years. Or they can take a lump sum out and it's just slightly less than what the line of credit would be. Of course, that comes at a higher interest rate. So these are things that you and I can talk about prior to having that conversation with the borrower. So how do we broach that topic of reverse mortgage that everyone cringes when they hear? So the first thing is we can't ignore the fact that home equity represents a large portion of a client's net worth. Another thing, housing is the largest expense alongside healthcare during retirement. So we can't ignore it. Most people are going to need some type of care as they age. Home equity can be used as a buffer asset to protect your investment portfolio and create a safety net for unforeseen expenses like long-term care, like bringing care into your home, things that long-term care might not cover. So these are very, very important things to talk about, when you're having that initial conversation or a client comes back to you because they're struggling. So even if we don't pursue a reverse mortgage, given your eligibility, we should examine whether it could help you reach your financial goals over the next 10 plus years. As I mentioned, that line of credit has that potential to double and they can have access to additional funds. This line of credit does not get turned off if the market changes. So it's super important to take advantage of that for sure. Reverse mortgages are not for the impoverished or a loan of last resort. They just aren't. They simply add an extra layer of financial security to your overall strategic plan. So this is just a complementary way to, again, make that money last longer. So the most common myths of reverse mortgage. So the first thing is they think they're giving their ownership over to the lender. That's not true. The borrower retains full ownership to the home's title, just like they would with any other mortgage. Myth number 2, the reverse mortgage requires monthly mortgage payments. It doesn't. There aren't required mortgage payment, but they do have to pay the property taxes, the insurance, HOA, flood, anything that's a mandatory obligation against the property. The whole goal is not to have a default on these mandatory obligations that would cause the loan to mature and, of course, become due. Myth number 3, the reverse mortgage must be paid back after 30 years or when the borrower turns 100. Not a chance. These reverse mortgages stay in place until age 150. So if any of your clients are, super ornery and they want to, break some records, we'll be right here cheering them on. But the home is only required to be repaid when a maturity event happens. So you sell the home, the last borrower passes away, you move out of the home permanently, and of course, like any other mortgage, you don't pay your taxes, insurance, your monthly obligations that we've talked about several times already. Myth number 4, to qualify, the house must be debt-free and paid off free and clear. So it's not true. The reverse mortgage will pay off any mortgage or liens against title so long as you have adequate equity in the property. It must be the only lien on title. So as I mentioned in the prior example, they had a house free and clear of 950,000. They were able to access about 300,000 of that, and they didn't have any liens to pay off title. Now, if they had mortgage liens, that would be subtracted from the amount that was available to them. Myth number 5, there will be nothing for the heirs. The reverse takes all of the equity. And that's very false. The heirs inherit the home like usual. They need to pay off the mortgage just like any other mortgage, and then they keep any additional proceeds. There are cases in which the balance of the reverse mortgage will exceed the present market value of the home, but the heirs are not going to receive a bill for that deficit. So that's very important. If the goal is just to live in the home for as long as they can live in the home, this is an excellent tool to do that with no required mortgage payments. They can choose to make payments at any time to, of course, reduce the speed in which the loan balance accrues. Number 6, with a reverse mortgage, they can't ever sell or refinance. Nope. The reverse mortgage is just like any other loan. You can sell or refinance at any time. The reverse mortgage is paid off at closing, just like any other mortgage. There's no prepayment penalties for paying it off or selling the home in advance. So if they would like to sell the home before they age to 150, they are more than welcome to do so. They could take those proceeds, use them to put themselves in an assisted living facility or any type of other care that is needed. So let's address the cost concerns. Most of the fees associated with a reverse mortgage, other than the government required reverse mortgage counseling, can be financed through the loan, thus cutting down the upfront costs. Typically, the only upfront costs are going to be for the government required counseling and for the appraisal. The appraiser needs to go out, make sure that the home has no health and safety issues, so that the lender can have confidence to put a lien against the property. Individual rates and fees depend on factors such as the present market day interest rates, the borrower's age, and the value of the home. Also, if they owe anything against the home, that's going to reduce the amount of funds that they will have access to. HECMs include an upfront mortgage insurance premium that ensures the availability of the borrower's funds and offers a non-recourse protection so that the borrower won't owe more than than the home is worth when the loan is repaid. It's very important to note that that is 2% of whatever the property value comes in at. So if the property comes in higher or lower than the time that we reviewed the initial request, the cost for that premium can go up or down as well. But again, it's 2% of the final appraisal value. So we provide a transparent analysis with the upfront costs. So here's an example of a fee breakdown for a HECM loan. The majority of the upfront fees are paid to HUD. It's for the mortgage insurance premium. That 2% is paid upfront or financed through the loan. That is the largest fee typically that will be on this fee estimate. The mortgage insurance premium ensures the availability of funds and line of credit growth. So again, we talk about, what if the values go down? Anything that was promised on the reverse mortgage from day one is protected by that mortgage insurance premium. So if you were promised those monthly payments of $1905, if you were promised a line of credit of over $300,000, whatever was promised at day one is protected by that mortgage insurance premium. So it also includes that non-recourse protection, which means that the borrowers will never owe more than the property is worth when the loan is repaid. So as I mentioned before, if the balance of the loan ever exceeds the present market value, it is a wash to your client and the heirs. No one's ever going to get a bill trying to recoup any additional funds. That mortgage insurance premium goes into an insurance for HUD, and they will file claim for any additional funds above and beyond the property value. So FHA insurance, the reason they have that 2% upfront is because it allows the program to exist. It allows for lower interest rate. The home is the only collateral. It protects the homeowner for however long they live in the home. Again, doesn't matter if the balance exceeds the value. It protects the terms of the loan, any payments that were promised, any line of credit that was established, or if you pulled out a lump sum, nobody's going to be knocking on the door saying, hey, you know what, your property doesn't, appraise for as much now, and we need some of that money back. And there's no liability to the heirs or the estate for any deficiency. That's so important. Of course, if there's any proceeds left, which in most cases there are, and you'll know that up front, how much to expect as far as proceeds left for your heirs will have access to that, and they will be able to be paid out through the estate. Eligibility. How do people qualify for these types of loans? So the homeowner must be at least age 55 plus. If there are a younger spouse, it does go off the youngest spouse's age. The older you are, the more access to equity that you have. So it's very important to note that. Now, if someone is using a reverse purchase if we're using a reverse mortgage to purchase a more suited home, they would need about 50% plus for the down payment, depending on their age. So the loan to value, which of course is how much are they putting down versus how much the loan is for, is affected by the age. It must be owner occupied for the life of the loan. That is super critical. Again, you can't use a reverse mortgage to buy another property, move out, and rent that property out. Now, they can be in 1 to 4 units. So if they have a multi-unit property, as long as they live in one of the units, and typically the bank is going to want to make sure that they're living in the most desirable unit. There's no manufactured homes. Some condos will qualify. It is, they must be FHA approved. And if they're not, sometimes we can get a single unit approval. So that's very important. Loan amounts up to $4 million, and that depends on the program and, of course, all the other caveats that come along with it. And you must account for any spouses. So if the spouse is too young, we have to account for them. If the spouse doesn't live there because they're, separated or getting a divorce, we have to account for them. So we can't just hide that spouse from the transaction. It's super important. Now, when is the loan required to be paid back? When the last borrower or eligible non-borrowing spouse either passes away, moves out of the home permanently, sells the home, or if the borrower defaults on their property taxes, homeowners insurance, HOA, flood insurance, other property charges, or if the home is not maintained, it gets condemned. So when I'm talking to people about their home, I'm asking them, is it a 2-story property? Is it 5 acres? Is this a property that will be able to sustain you for the rest of your life? Are there lots of stairs? Let's talk about these things up front, because maybe the reverse mortgage for your current home isn't a good idea. Maybe using a reverse mortgage to purchase your forever home is a good idea. So I would like to help you help your client live their best life. Here's my contact information. You can reach out to me anytime. Most of you have my phone number on my profile. I just wanted to let you know that we have, opportunities everywhere. Seniors have over $12 billion in equity. And most of them are not tapping into it because they're fearful. So let's break down those walls. Let's talk about this. Let's have, an amazing chat and see how a reverse mortgage can best suit your client. So I'm going to give it a couple of minutes to see if anyone has any questions. If not, again, you can watch the recording. You can reach out to me directly. I would be totally happy to help you. And I thank you so much for your time.